Before we start, Andy, I just wanted to say a quick thank you to our podcast sponsors, Money Farm. Now, Money Farm are the largest digital wealth manager in Europe, and they create portfolios of ETFs for their clients. They're incredibly cheap and ideal for somebody who's wanting to get into investing, and perhaps for more experienced investors who don't actually want to run their own money anymore. Now, they will even offer to run the first £20,000 of any of our listeners' portfolio absolutely free if they enter the code MTTM20K into the website at moneyfarm.com. For more information, check out their website. But for now, Andy, let's get back on with the show.
Hello and welcome to episode 166 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leeks. Damien, a special episode. I'll let you tell the listeners what's up.
Well, it's our birthday. Money to the Masses turned 8 this week, which is, well, it's something to celebrate. I mean, 8 years ago, we started this whole journey on Money to the Masses. And for people who listen to this podcast regularly, they know the story. For those who are new, I started Money to the Masses as a mere blog, as a means to throw some ideas down on the internet 8 years ago. The day after I came back from paternity leave, I was a bit disillusioned with working for a firm that gave advice to very, very rich lawyers, and decided I wanted to do something more and something a bit more fulfilling. So I started writing Money to the Masses in the background as a blog, just giving away the expertise we were charging a fortune for to the ordinary people out there. And it was something I did in the evenings, in the early hours of the morning while I had my day job. 4 years later, I quit my job, worked on it full time. Money to the Masses grew into the site that you all know and love, the podcast, the books, the 80-20 Investor, One Giant Leap, all those things, and we are 8 this week. So, I mean, yeah, there you go. So I was pleased as a milestone. Every year we have an anniversary. It's a great reminder of how far we've come, but also how much things have changed, not just in what we do, but in the world of finance, which is going to be one of the pieces that we do today, which I think people will enjoy. So, yeah, it's a celebratory week for us, Andy.
Yeah, huge congratulations. I saw it posted over the internet. I know because I know your daughter's age, and when she passes her birthday, I know that Money to the Masses is very soon going to pass her birthday after that. You've inspired many thousands, and myself included. I'm just thinking of all the things I've done over the years as a direct result of reading or listening to you and your advice. And that's not just you as a friend, that's me following what you do, and I think you should be really proud. And yeah, that's heartfelt from me. I'm hugely honoured to be a part of this. Anyway, enough of the gushy stuff. You mentioned earlier what we're going to be talking about.
I've got something in my eye, Andy. Hold on.
Yeah.
No, one of the things we're going to do is we're going to talk about what's happened in the last 8 years, and maybe touch upon some of what might happen in the future with regard to the personal finance space. And the other things I want to talk about are the stock market. I promised last week that I would, well, I didn't promise, I said I might come back to talk about a follow-up piece on the stock market and examination that I did last week of the crash, and I think it's worth doing an update on that. So I'm going to talk a bit more about what's happened since and some other interesting things around that. And also, finally, I'm going to do an energy mythbuster. So some things, some myths that are out there that I suppose I should say some perceived truths about ways to save energy that are complete nonsense. So we're going to do that as well.
Good. Well, let's start off with focusing on Money to the Masses and this 8-year milestone. Yeah, so I've got some questions for you, actually. You're 8 years old today. I thought it might be nice to ask you a few questions about your 8 years since you've started Money to the Masses. Maybe perhaps, your proudest moment, what frustrates you the most. I suppose the one thing I wanted to ask you is, what has been your proudest moment? Now, you might not be able to pick out one, so feel free to do 2 or 3, but I'd be really interested to know, in those 8 years, what has been your proudest moment?
I could tell you one thing that stuck in the memory of a moment when you sit down and I thought, wow, which was I printed my business cards. And now that might sound really stupid, because most people go out, come up with some harebrained idea to have a business, and they print their business cards first. But the difference was, for me, is because I never did the business card thing. When I started Money to the Masses, it was to help people and push stuff out there. And so it was something I was doing in the evenings for years. and it was something that people thought I was nuts doing it. I'd be up into the early hours, running myself into the ground doing it, and it was an itch that I wanted to keep scratching. And I lost count of the number of people who said to me, "How are you going to make money out of it?" And that was never the intention. And so it was the reason I did it is because I loved doing it. And that sounds corny, but it isn't. It was one of those things that I just wanted to do, and I enjoyed the writing. So the point at which I had the business card was a necessity, actually, because I was going somewhere, representing me as Money to the Masses, rather than Damien Fay of a company that I was employed by somewhere in my career, to go as my own person who was being called a finance expert, money expert, whatever you name it, by the press, and going somewhere like that. It felt like more that I'd earned it, and because it was a first physical representation of what we'd done, I suppose beside the book, but it was the first thing that was with the logo and everything like that. It was one of those moments where something that is in your head that you write then becomes physically enters the real world, that you give it to somebody that they would take. That was one of the moments where I was just like, whoa, and sort of had a moment with when I did that. But I suppose when you say the proudest, I probably, one of the proudest ones is 80/20 Investor, because it helps so many people to learn how to invest, and people run millions of pounds using it. So it's teaching people how to run their own money and take control. That I love, because to create a product that isn't prescriptive, doesn't tell people this is what you've got to do, but to create something that can make people better at investing. So if you think of it like in the football world, it's a bit like getting people to teach them how to play football when they become far better footballers than you could be. Do you know what I mean? It's something where you can enhance people's abilities and allow them to go and do something, and they can make even more money than you do. And that I love, because it's not about, the world of finance is built around the fund manager or IFA saying they're the smartest person in the room, give me your money. And to try and come up with something like that, that was, for me personally, that was an achievement. So, like you say, I could list others, but I think that was probably the biggest.
Yeah, good. I'm intrigued to know what your biggest frustration, because you, in the industry that you work in, you must have, frustration on a daily basis, hearing the sort of things that you hear. What's been your biggest frustration? What haven't you been able to maybe absolutely nail?
I suppose the biggest frustration, if people look at the changes in the financial services world, this is the whole idea behind Money to the Masses, is to empower people, but a byproduct would be to try and reform the financial service industry. It's a long journey, and I've not been able to do that yet, but we're on that journey. And I suppose the biggest frustration has been the financial services industry, and particularly financial advisors. Now, I don't know if people realise, but bar one or two particular maybe websites in the UK, we probably encourage more people to engage and get financial advice than any other website out there. Certainly, must be one of the leading referrals in that regard, because we help people decide whether they need it or not. We don't just say everybody does. And the financial services industry, there are people within that who still, their underlying motivations have not changed, and their attitudes over the years. So despite them being an industry that there are definitely some good guys in there. I say good guys, good ladies in there, and particularly some of the younger IFAs. But the industry itself, its motivations haven't really changed. You can see that in its behaviour. So what will happen is they say they're aligned with giving customers the best satisfaction, best advice, but there's always an element of the majority have their clients' best interests aligned. By that I mean, for example, you can get contingency fee, so they get paid if you do something. Now that still occurs, and that is one of the ways that some people can afford advice, so they might give you advice to do something, and then they get paid once you start to implement these things. Now that idea is inherently not always going to produce the best type of advice. So as an industry, my biggest frustration is there are some good people in it, but the most of the industry thinks that they, rather than try and reform itself and trying to oust the bad people within an industry, they actually just sit there and try and defend what they're doing and moan about other people and say, why are they having to foot the bill for poor advice from other financial advisors, but they do nothing about it. They're all very insular. If you go into a room of financial advisors, they do, as a group, and it's not everybody. I don't care if IFAs want to have a go at me, but I'm just telling you this is the reality. They're all very much about their clients and what they do. There's not very much of a collective responsibility going on. So that's one of my biggest frustrations. I think the financial services industry hasn't really moved on in terms of its attitudes, and some of those that have, or some of the behaviours that have started to change, have largely been forced upon them. And I think one of the positives of the last 8 years was RDR, which was the Retail Distribution Review, which made the charging for financial advice much clearer.
Good. Okay, so the interesting question, this is quite evident how you help the listeners and the readers of the website and through the podcast and everything else. Obviously, we do that on a weekly basis, and you're doing that on a daily basis through the site. I wonder, it might be interesting for you to be able to tell the listeners and perhaps the readers of the website how they can help you. How can they help you build as a brand and build as a website and a podcast? And what, there might be a listener there thinking, I love the free advice and the free podcast and this, that and the other. I'm not really helping Damien, but I'm sure there are ways they can help, and it won't cost them in their pocket.
Look, the one way they could do is just to share what we do. And if you feel inclined to tell friends and family about what we do, the website name, and that is the biggest. If you share things on social media, Facebook, if you want to write to newspapers and sing our praises, then that would be fab too. But really, it's just to engage with everything that we do. Leave reviews where you can. And I mean, we've had some great reviews this week on the podcast, for example. There was one on One Giant Leap, which we had this week, which I'll read it out because we said we'd read reviews, and actually, Andy, we've had an influx of reviews because we started reading them out as one of the readers suggested. So there's another example. I like the feedback. If people suggest stuff, we will try and change it, whether it's the podcast or website. So it's always a journey we try and grow with. So we actually, even though I've not done a One Giant Leap podcast for some time now, Dr. Jules left a review saying, I've been listening to Damien's podcast for some time now. This is the Money to the Masses one, and he came across the One Giant Leap ones. I've listened to them all, and they've been nothing but inspirational. The way the interviews are done, questions asked, and stories that are told by the actual people who've walked the walk are just mind-blowing. One more thing that really hits home is what Damien says a few times in a few episodes: good guys do succeed. I think that is what this world needs and what I'd like to tell my children. So that is another good review. Funny enough, actually, as an aside, I saw somebody else has tried to launch a podcast called One Giant Leap. Maybe they just inspired by what we did, Andy. But we've had other reviews this week on this podcast. One of them, David Mendoza. He must be Spanish. But great and honest advice for everyone, rich or poor, which is one of the things that hits home, because that was the whole purpose of Money to the Masses. It was for everybody. And Fordikov, I think this is, also wrote, good advice on the market drop this week and a light-hearted approach. We'll listen every week, thanks. And that is also fantastic to hear, when people really appreciate something we did. Because I listened back to last week's podcast on the market correction, and I have to say it was actually a good piece on the market correction, if I do say so. That sounds awful for me to say it, but I had to listen to do the follow-up piece this week. But it was pretty good, so I have to...
It's a bit of a love-in, Damien, because I think I even remember texting you midway through the week once I'd done the editing and re-listened back and stuff, and I just sung your praises. I thought it was a really good piece. But anyway, what sort of podcast is this?
Yeah,
just saying
but what I want to do now is turn this portion slightly and want to run through some of the good and bad bits of the last 8 years, okay? And I want to inspire people who listen to this podcast, because one of the things I want to drive home, since I started doing Money to the Masses 8 years ago, the world has changed significantly in terms of fintech and financial solutions online, and people may not realise, but there are some fantastic solutions to personal finance issues, whether it's investing, whether it's needing your mortgage reviewed. We try to bring you these on Money to the Masses and the podcast, but there are lots of wonderful solutions out there that make managing your money far easier than it's ever been. For example, 8 years ago, I would be in an office working for somebody, and if a client wanted to invest in an ISA, they had to really do it through an IFA, and they would come in with a cheque and pay a cheque in, and then the IFA takes their chunk, blah blah blah. I mean, you just don't have that now. You can go and invest in cheap trackers if you want. You can have products like we have, 80/20 Investor. You can go online and invest via platforms. And the costs have come down so much that even though competition has driven that, but part of it is because the gravy train that existed in the financial services, there's a light being shone on it by various different bodies, including the regulator, and things are getting more cost effective. So people should be positive. There's never been a better time to manage your money, and you can do a lot of it yourself. And of course, there's open banking, which we discussed a couple of episodes ago on the podcast, which enables people to use technology to be able to monitor their money, be able to see if they're going to run out, etc. So, and don't forget, we've had robo-advisors that have come of age and started to make investing more accessible to the wider public at much lower rates, so lower minimum, so you can invest from £1 with some of them. So that is brilliant. I mean, I love that. So if you're listening to this podcast, you should feel upbeat, inspired, which was one of the ideas behind the 30-Day Money Plan book, was to try and get people to realise that and take action. Now, I remember reading years and years ago, when I first started on this journey, Martin Lewis, money saving expert, once said the hardest thing was trying to get people to take action. Now, that hasn't really fundamentally changed. That is still one of the issues we have, and we've got better and better at Money to the Masses at getting people to take action. And I think one of the disappointing things about the UK consumer is that hasn't changed enough. We need to keep encouraging people to take action, but break it down into smaller bite-sized pieces to try and do simple things, maybe like just reviewing their mortgage, rather than trying to take on the whole holistic, sort everything out. So that's one of the things. The one other thing I just want to mention that's slightly disappointing is I think the advice gap has got wider over the years. I think there's been the rich people get advice, financial advisors, because of RDR and the way it was implemented, now predominantly target richer and richer people, so the rest of us don't necessarily have access to affordable financial advice. And some of that is down to the fact that advisors charge too much, but part of that reason they charge a lot is because they've historically done it, but also because of the responsibilities that they have in giving that advice. There is a cost, but also the future liability of that advice if you were to go back and complain. One of the downsides, I would also say, there's more scams prevalent now than ever was. That's part of the downside of technology, so you have to be more alert. I think consumers are more engaged than they were with financial matters than when I started, but I don't think they're enough.
Agreed.
I think the financial education stuff we're seeing in schools is positive, but it's not the full solution. I still think we chuck old people on the heap and don't actually realise that they are a good font of knowledge, but we just need to make sure they're telling the younger generation the right thing. And I have to say, one of the other disappointments has been, I think the gap between generations has got wider. So I think the younger generation are poorer while the older generation are richer. And my reasons for saying that, this isn't the baby boomers versus the millennials, but the fact is that the older generation, with things like quantitative easing, all these things we talk about in the podcast, they benefit people who already have money. If you invest in equities and have investments and assets, when we have money flooding into our economy, it benefits those people who have that stuff. The people who don't yet don't benefit, and so it widens that gap. And I think that is a disappointment and something that's got to be tried to be bridged over time, because I'm not sure the younger generation are going to inherit as much money as they think they will, because the older generation are going to live even longer. The millennials' children will do. I think they will. But I think this middle band, which will include the likes of me and you, Andy, I think we're just outside millennials. We might try and squeeze in if we're if we're trying to be cheeky. But I think that's a slight disappointment. I think it leads on to things like the scams, like I said, but Bitcoin, things like that, actually play into the hands of millennials' hopes. They want to try and get onto the property ladder, so they want something that's going to be perceived to give them quick returns. I think we've become very short-termist. So we're very short-term in investing, in everything we do, whether it's we don't save for the future. I think that's got worse. So we've got to try and battle that. And the other thing, before we move on, is credit. I think credit has become even more of an issue. We have more credit than we ever used to. And that's been encouraged by the Bank of England and people like that by making credit more affordable. And I think that is something that's a problem that we need to try and help people manage. So there's a lot of positives that I think the world is far easier. You don't need to worry about money. There are people like me and others who are talking about money that are helping people. And there are challenger banks and all these things disrupting the old guard. That is good. But there are still some legacies of that old guard you have to be aware of. And there are some pitfalls of this new world where scammers come along. And one final thing I just want to mention that is just my general bit of advice to people when I look at what goes on in the journalistic world, is that I think the financial journalism has got worse over the last 8 years. I think there's a lot more clickbait, even from the leading publications. I think they were partly responsible for really blowing up the Bitcoin bubble. I think there's others that they do as well, but they, in order to get clicks and views and to drive advertising revenues, they will pretty much write anything that will be popular, and popular isn't always useful. And sometimes I actually think it's dangerous. So I think that's one thing I'd finish on. If you look at the newspapers, always question who the people are being quoted, what their motivations are, because they're getting into the papers far easier. Journalists will just ring them up for a quote, and I think the level of journalism isn't as good as it was 8 years ago. So I don't think there's that investigative journalism in finance now. They are sometimes just publishing PR releases. So I'll finish on that. That's the slight negative. But going forward, I think that things should get better. We've still got challenges, but going forward, consumers haven't changed really. They still got the same fears. Just like you're sitting to listen to this on the train, the guy next to you has the same fears as you've got. You just don't realise it. I see what people read and engage with what Money to the Masses do. You're all the same. We're all the same. We're all human beings. But there are positives, but there are still challenges ahead. Before we move on, Andy, I just wanted to quickly mention 80/20 Investor. Now, 80/20 Investor is my DIY investment service. Do go and check it out. I empower and teach people how to invest their own money. The service provides data-driven fund tables. The data is driven by my own unique 80/20 Investor algorithm, which I created. You also get stop-loss alerts, you get research articles and insights, you get market commentaries, monthly commentaries, and DIY investment lessons, but you also get access to my £50,000 portfolio, which is a portfolio of my own money, which I run live on the site for members to see, and it shows people how I use the service to maximise my returns. And in the first 2 years of doing so, I turned £50,000 into £59,500, which is a 19% return, beating investment managers, professional fund managers, financial advisors, investment banks, passive trackers in the market. So everybody can have a free 30-day trial of 80/20 Investor, and you can claim that by going to moneytothemasses.com and going and clicking on the 80/20 Investor hyperlink at the top of the page. So go and try the service. Let me know what you think of it, and I know from the feedback that you're going to love it. But for now, on with the show.
Okay, Damien, so following on from, well, firstly, that lovely advert there reminding our listeners to check out 80/20. Following on from last week's piece about the markets, what's going on, you've got some more on that, some meatier stuff.
Well, it was one of those things I thought deserved a follow-up, because we left people with the world was imploding. We were telling them not to panic, it was a good reminder to review risk. And so what happened after that? It would almost be, what's the sequel? So what has happened in the last week has been really interesting. Now, when you get sell-offs and markets collapse, I know it might not feel like it at the time, but you need to think about how great an opportunity it is to learn. You see so much stuff going on in terms of how assets behave with each other, because it happens at very high speed. You get changes in trends, you get crazy behaviour by people in the market, and so you get to see the sort of dynamics of things in a very short space of time. Something that might take months or years to play out, you might see in sort of a half a day. And that kind of dynamic is very good because you try and understand what's going on. You can't explain everything, and this is one of the issues of what's happened, as ever, with these sell-offs. So what happened after last week? We did the podcast. The VIX products had imploded. They were still there. They were still causing issues. But this week, they seem to have almost died. That trade has dissipated, at least for now, and the concerns about inflation they still persisted, and we had that get ramped up a little bit more. Do you remember I was saying about watching the VIX, the fear gauge? Well, that started to come down. It's still it's around about, as I talk, about 20 on that gauge, which all you need to know, that's the historic average, way above where we've been for the last few years, but it's about average. So that means the fears come out of the market slightly, and therefore equity markets have rallied, and they've stayed some of the best rallies they've seen in the last couple of years. Now, the question is whether that's sustainable. That will come on to that. But the other thing is bond yields have continued to rise on that 10-year Treasury. So we're up to about 2.9 now. The point is the inflationary concerns are still there, but they're seemingly being isolated to bond markets for now, and that could change. And what's happened is people are now becoming more relaxed. They think equities are going to go higher. They've suddenly decided they don't really care about this inflation concern anymore. They're going to take it on the chin. And actually, it was those nasty VIX short sellers that were causing the problem. So that's where we are, and the markets have bounced back. They're not near where we were all-time highs, but we've come back probably. I don't think we're quite halfway on the American stock market, but we're certainly getting there. Now, the bounce is uneven. It's not in every market. Some of the reasons for that, the dollar is going through the floor at the moment, so that's dragging down the Japanese stock market, because I don't know if you don't know this, but the dollar-yen exchange rate tends to influence how the Japanese stock market fares. If the yen is strong against the dollar, then that's not very good for the Japanese stock market, but if it's weak, then it is good. So at the moment, the yen is getting stronger. Bond markets are not faring that well. So what happened is bond markets started to fall along with equities during the sell-off, but bond markets have continued to fall. So as a diversifier, they're not doing too well, but equity markets have picked up. So your portfolio, if you look at it, will just look a lot healthier than it did last week. Now, what is interesting is what's going to happen now. Now, we don't know. There are lots of people saying it's all fine, it's all behind us. Maybe that is right. Who knows? But what will likely happen is from here, there could be three outcomes. And now this is going to sound pretty obvious. We could end up having an immediate correction downwards, which I know seems unlikely if you look at the market at the moment, but that's not to say it won't happen. But you could get something that happened in the bubble of the .com bubble, where you get a rally and then a sudden sell-off, so almost like a dead cat bounce, they call it. Or we could just keep going to higher highs like we did after the 2015 sell-off. Now, we don't know which is going to happen, but that's just to be mindful that we've had scenarios like this in the past where we've had each of those things happen. So we're not out of the woods just yet, but it is where we are at the moment is just a good reminder of the idea of not to panic in these situations, which is what we were talking about last week. But if you think about it, if you look at the stock market at the moment, the general uptrend in stocks is still hanging in there. It was hanging in by the skin of its teeth earlier on in the week. It's still there at the moment. How long that will last, we'll have to see. But as an experiment, if people want to know, how do you know that? Get a ruler out, get a chart of the stock market, and we'll just do this with the typical printout you get. There are people who talk about logarithmic scales, which is where you give more weighting to what goes on more recently. Don't worry about that. Just get a typical chart of maybe the US stock market and it going up and down. If you put a ruler on there and you try and join the troughs, the bottoms of past falls, going back for as long as you want, if you get two troughs on a line on that ruler, then you can draw a line between them. If you can get a third one is also on that line, that confirms a trend. It's a very finger in the air way of doing it, but this is pretty much what technical analysis is. You can do the same thing for the peaks. So you're trying to join up as many as you can in a straight line. And what happens, those rising trends are what a lot of technical analysis people look at. So they can be support lines, so when the market gets there they might bounce up, but if they go through them that could be a sign they could fall further. The opposite is true on the upside, so if they go hit a resistance level, the previous peaks are suggesting are going to prove tricky. If it smashes through that, then it's happy days, we're going to all be rich. So it's an idea that if you're interested in what's going on, have a look at stock markets and see if you can spot those trends. And there are lots of tools out there that do it. There are people who talk about moving averages. So that's the taking, say, the last 200 days of the movements in a particular index, and they create another line that's far smoother. And if you go through that, that's not a good sign. So they look at the 100-day moving average, the 200-day moving average. The 200-day moving average tends to show if you go down through that, that's a negative sign, and there's a general trend change in overall direction. If you go up through it, then that shows you're generally changing direction to the upside. So the answer is we don't know where we're going to be. But again, going back to last week's podcast, it was a good reminder that you shouldn't panic in these situations. You should focus on the long term, but readjust your risk. It was a good warning shot for everybody to look at the risks they're taking. If you're worried about your money at night, you're taking too much risk. So just tailor it in, just pull it in a little bit until you're comfortable. And going forward, it's quite interesting to start looking at these markets, looking at how stock markets, the waves in stock markets, how they move up and down, and seeing if there's a trend forming, because that's how you start to perhaps learn about these things. Don't obsess about it, but it's good just to start to spark an interest. Can you spot a line? Could you draw a line on a graph? And if you can, you start thinking, do you know what? This is quite interesting and something to explore. So there you go, Andy. A bit of a quick update on where we are with the markets. We are in a point of everybody just going, relax.
Lovely. Bit of market advice, investment advice, and a little bit of technical drawing help as well. I like it. I'm going to give that a try. So moving on to the last piece then, you mentioned about energy bills and you're going to debunk some myths. You're going to play Mythbuster.
Well, I'm going to just ask you, Andy, the questions, and so you can tell me the answers. And
okay.
Yeah, so the first one is regarding your thermostat. So does turning your thermostat up higher, does that heat your home quicker? Because there's lots of people that say it does, and there are some people who say it doesn't. So if you want to heat your own home up quicker because you've got indoors and it's cold, and you whack it up high, does that heat your home quicker?
I think I know the answer to this. I'm pretty sure it doesn't. All it does is make sure that your heating stays on for longer, because it's never going to get below the certain temperature that you set.
Andy, you're spot on. And even this quiz, well, it wasn't a quiz. There was an article about this I think it's in the Daily Mail. And they actually got somebody from the Energy Savings Trust to talk about that, what you've just said. And that's what exactly what they said is basically, well, you'll just leave your heating on, won't you? So no, whacking up the thermostat doesn't do anything for you. All it does is make sure that your heating will never turn off and you'll all start wilting. If I go down to my mum's house, you could grow tomatoes in her living room. I kid you not. She has her heating on so high that I go in there and start wilting. So I know what happens if you turn up too high. Should you? This is the next question. If you want to keep your home heated, should you leave the heating on all day at a low temperature, or should you turn it off? Which is best? Because there's the one school of thought that says you should keep your heating on the thermostat low to keep your house at a low, even temperature, rather than have a timer or anything like that just keeps turning your heating on and off. Which is better?
Yeah, interesting one. I know, for example, if I'm going out for a day and I won't be back to a certain time, if I know that the timer isn't quite going to kick in time, I will put it on low, just because I don't want to come back to a frozen home. But generally, I trust the timer, and I think that works fine. I don't know the answer to this. I'm gonna say that it's not a good idea to keep it on low.
Well, I got this wrong, but Andy, you got it right. You should apparently use the timer. That's the best idea. Use a timer or programmer to make sure your home is heated only when you're there. Otherwise, you'll be wasting energy. Now, I thought the opposite would be true. After my heating escapade, my fast, that was the boiler blowing up, I felt it took my house ages to heat back up once the heating was on. I just felt all the heat had evaporated from the walls, the floors, everything. It seemed like a day for my house to get back to normal, but obviously I was wrong. I was just being a wimp. Right, the third one. Should you keep the doors open to allow the heat to circulate through your home?
Oh, okay, the internal doors.
Yeah, sorry, no,
the exterior doors.
Should you heat the street? No. Should you leave the living room door open and the doors to allow the heat to move and circulate through your house?
I must admit, I do that because I think that happens. But thinking about it logically now, you've got radiators in each room, and if you close the doors, you're going to reduce the space by which it's then heating up, and it'll probably heat up quicker. So I've been doing it wrong, haven't I, Damien?
You have, Andy. You've been doing it wrong. You've been wasting energy. Apparently, you shut the internal doors because it allows the convection of the air to rise up to the ceiling, start to come back down again, and then be heated up by the radiator again. That nice circular movement, apparently. If you open the doors, you destroy that. So, Andy, you are wasting energy. The fourth one. Now, this made me almost cry when I read this. because I've been worrying about it ever since. Does using an electric heater for a few hours, is it cheaper than using the central heating? Now, bearing in mind I had probably 3 electric heaters on the go non-stop for 3 days, I'm surprised the South East London didn't have a blackout, to be honest with you. But what is the answer, Andy, to that conundrum?
I'll be honest. I've always steered very clear of electric fan heaters and stuff. We've got an oil heater that we use as an absolute backup, but I know they when I had an electric meter in the house, I knew how much they took up. So I'm going to say, don't do it. Just don't do it if you can avoid it. Did I answer the question?
You answered the question. Don't do it. And they typically are the most expensive way of heating your home. So because they run on electricity rather than gas. The final one is this is probably it is interesting for people who rent. There is can you switch supplier without your landlord's permission if you rent a home? So you're obviously on a particular tariff of a particular provider which is expensive. Can you switch?
I just know from my own experience that you can. I've rented previously and have changed the supplier as often as I could, and with the landlord's permission, basically. So, well, not with their permission, but the fact that they knew that I could do that. Legally, yes, that was fine. So, yes, you can.
Oh, well, there you go, Andy. So you got that one right. Yeah, you can, as Andy says, you can switch as long as you, without the landlord's permission, actually, if you pay the bills. If he pays the bills, you're going to have to ask his permission. The one thing you may come into an issue is if you want to switch the type of meter. So you say you went from a prepayment meter to a normal meter, credit meter that most people will use
right.
that own their house. You might not be able to do that because obviously the structural damage. So there you go, some debunked myths, and one of them which basically is saying to me, Damien, you have got the biggest energy bill coming.
So, Damien, we're all done. May I be the one to say once again, happy birthday to Money to the Masses. It's been a pleasure working with you. Congratulations. I suppose before we end, it might be interesting. One thing we didn't cover when we were talking about it earlier, just a quick piece. We've had 8 years so far, and we've known what you've done. Any plans for the next 8 years? I'm sure you've got loads. What would you like to maybe achieve in the next 8 years?
I would have to say I would like to try and reform the finance industry, but I'd like to be able to. Let's go big. Let's go big, Andy.
Yeah.
Let's try and change the world. I would actually like to get to the point where we could give financial advice for free to everybody in the UK. Now that is so ambitious that it's some people may think it's crazy, but I don't care. A man sent a car into space this week, and if a man can put what's his name, Elon Musk or whatever his name was, the guy who he sent his own car into space, which is now heading towards Mars. If we can do that, and the amount of money that costs as well, I'm sure we can give advice to people in the UK for free if somebody really wanted to do it. So there you go. I'm not going to put my rusty old car into space. I'm going to do something a little bit more altruistic.
Good. Okay, if you want to get in touch with Damien, of course you can do. Twitter is a good place to start. It's at Money to the Masses, and that's with the number 2 in Money to the Masses. Or you can do it by email as well, of course, and it's damien@moneytothemasses.com. Please do review the podcast if you like it. If you don't like it, don't review it, please.
Yeah. One thing that never changes after 8 years. I know the podcast hasn't been running for 8 years, but Andy, forever, he always messes up this end bit. We've already done it twice, so you don't hear this. You only hear us sounding good. But yeah, Andy's just messed up again. Anyway, yeah, that's it for this week.
It's why I'm such a fan of podcasts and not so much on radio. In fact, I haven't had a call to go back on local radio in the last few months. Now I know why. Right, until next week.
Until next week.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.